Welcome to 3.5.1 Profitability Ratios. We're going to first talk about ratio analysis, what it is, and before we go into the three profitability ratios I mentioned. So, ratio analysis is a quantitative management planning and decision making tool which is used to analyze and evaluate the financial performance of a business. Profitability is a measure of profit in relation to another variable. So in the IB business management syllabus, we look at three ratios, which is gross profit margin, and return on capital employed. We're going to go into further detail on each one in the upcoming slides. Um, there is also, after these, we'll be going into liquidity and efficiency ratios in the upcoming unit chapters. Ratios allow firms to make historical comparisons of financial performance during different time periods. The profitability ratios examine the level and value of a firm's profit, thereby enabling different stakeholders to measure the financial performance returns on their investments. So, a gross profit margin to start off with, it's a simple ratio that just looks at the gross profit over sales revenue. So is a profitability ratio that measures an organization's gross profit expressed as a percentage of its sales revenue. It is also an indicator of how well the business can manage its direct costs of production. So gross profit itself is the difference between the firm's sales revenue and its cost of sales. So sales revenue, money coming in, minus the cost of sales revenue. Let's see if we can get that on the highlighter pen. So sales revenue minus the cost of sales is the gross profit. You have not taken out expenses, you've not taken out taxes, anything else, just the gross profit. And so you've got the gross profit, which is sales revenue minus cost of sales divided by sales revenue. Very simplistic. And times 100 gives you the gross profit margin. So we'll use an example here, which is a firm has a sales revenue of $100 million. The cost of sales is 55, and the expenses is 25. Therefore, a firm's gross profit is 100 minus 55. 25 is not included because it's expenses. We're just looking at the gross profit. So that's 45. So 45 into this ratio, so we put here 45 over 100 times 100 equals 45%. This means that for every $100 of sales revenue, the firm earns a gross profit of $45. Hence, the higher the GMP ratio, the more profitable the firm has been from selling its products. How to improve gross profit margin? A firm can improve its gross profit margin ratio by any combination of increasing sales revenue and reducing its direct costs. Such methods can include, and let's just highlight them one by one. Changing, that's not the right one. Let's see if we can erase that. It's not erasing. There we go. Great. So let's go back to the highlighter pen. So changing the firm's promotional strategies. It's number one. To try to persuade customers to buy the firm's goods or to ask to make more promotional strategies, 10% off, 5% off, get more customers buying to increase the amount of revenue coming in. Launching new goods or services that have higher gross profit margin, reducing the prices of products sold in highly competitive markets in order to attract more customers, outsourcing production in order to reduce the costs to or to give it to other operations to third party suppliers, which again reduces the cost. So you're going to increase the profit by increasing the sales revenue, by reducing direct costs, or increasing the price also, which is not listed here. If you increase your price and customers still pay the price, even if it's a slight increase and the same number of customers are buying, then your profit will increase as well. Next, we have the profit margin ratio. The profit margin ratio measures the firm's overall profit after all costs. Let's highlight after all costs of the production have been deducted. All still can't get this straight. As a percentage of its sales revenue. It is also an indicator of how a business can manage its indirect costs, which is the overhead expenses, things that are not related to production, like rent and electricity and other costs. So, the profit margin ratio is calculated using the following formula: profit before interest and tax. So everything else before interest and tax divided by the sales revenue. So that sales revenue that we had before has gone through taking out the cost of sales, then expenses, and then we're left with profit before interest and tax divided by sales revenue times 100 because of percentage. The higher profit margin the figure, the better the organization's control over its expenses, hence the higher profitability tends to be. It also indicates greater efficiency in managing the firm's overheads. Profit is the financial surplus after all costs, including expenses, have been paid for. For example, we'll go with the same example as before, which was the $100 million minus the cost of sales, 55 million, and expenses or overheads, which wasn't taken out last time, but it was mentioned. So therefore, when you take all three, all yes, all the both these together, not three, you've got 55 minus 25. You're left with 20 million. So 20 million over 100 divided times 100. So you're left with a figure of 20% here. That means for every $100 of sales revenue, the firm earns a profit before tax and interest of $20. So the higher the profit margin ratio, the more profitable a firm has been. And obviously, this is a bit more accurate depending on um, what type of investor you are and what numbers that you're going to be taking profit from. Is it before the overhead costs or after? How to improve the profit margin ratio. So businesses need to find ways to reduce any type of excessive and unnecessary expenses. The main difference between gross profit margin and profit margin is the expenses. So we're looking to reduce it. Examples include if it's not necessary, insurance, lease payments of equipment and other fixed current, non-current assets, mortgage payments, phone and internet services, rent on commercial buildings, salaries for management and administrative personnel, and utility bills. Just have to see how efficient these different expenses are being used. Sometimes there's travel expenses, which are also Lockdown could be lunch and different food expenses that seem it might be excessive, traveling that's not related to the business. And we've got the third profitability ratio covered is return on capital employed. Return on capital employed is a profitability ratio that measures the firm's efficiency and profitability in relation to its size as measured by the value of the organization's capital employed. So don't worry about the new terminology. Like I said, you have to get used to it. Capital employed is the value of the funds used to operate the business to generate a financial return from the organization. It is the sum of the non current assets and equity finance. So the machinery that is used to generate money, and equity, the investor money that was used to run the business. The formula for calculating capital employed is therefore non-current liabilities plus share capital and retained earnings, which is basically equity. So it's simplified here. Non-current liabilities plus equity. So this is what capital employed is. The formula for calculating return on capital employed is the figure of profit before tax and interest over capital employed. So it's looking at the money that we used or that was being used to make money, the investments that have been used to make money into this business. How much money is that making as a percentage? Improving return on capital employed, the ratio strategies, one of them is to increase the firm's sales revenues. By using such strategies as reduce prices to attract more customers, similar to the others. Reduce costs of production, again, similar. So once you remembered one, you'll see that they're similar to all. And selling unproductive, unused, underused, and obsolete assets in order to improve operational efficiency. If you've got, you know, ma- machinery that you're not using or haven't used or not as it's better to buy a new one than sell the old one, even if you're getting a scrap value, get something better than nothing, and buy a new machine instead. Here we've got it in summary. Some of the key terms: profitability, measure of the business ability to make profit from a sale, from sales or capital investment, and the three that we discussed: gross profit margin, and return on capital employed. Capital employed, the value of all long-term finance invested into the business, as mentioned before. And now we're looking at liquidity ratios. Okay, so maybe you want to take a pause here before going into liquidity ratios. There's a lot of information to take in, so would be good for you to pause and come back. But if you want to carry on, then I'll be continuing. Liquidity ratios and possible strategies to improve these ratios. So, liquidity ratios are financial ratios that examine the organization's ability to pay its short term liabilities and debts. Liquidity ratios refers to the ease in which a business can convert its assets into cash without affecting the market value, i.e., the ability to pay long term liabilities without using external sources of finance. yes, there's a lot of terms, and at the moment you're just reading these words. Let's just get rid of that. It's a little distraction for you. So yes, you're just reading a lot of information, but yes, we will go through uh, in more detail coming up. So these liquidity ratios are important for like banks, people who have borrowed you money to see, or investors, or who are going to lend you money, not investors, other people who would lend you money to see just when will you be able to pay them back. So you've got current ratio and you've got asset test ratio, known as a quick ratio. These liquidity ratios are used by managers and other decision makers to measure the extent in which an organization could pay off its short-term debts using its current assets. So it's really important that all for all organizations to manage their liquidity in order to prevent a liquidity crisis. When you run out of cash, we're running out of money to pay people. That's very important. You could be a very profitable business. I'm sure this will be mentioned again. Uh, but if you run out of cash, you don't have cash, it's not liquid, you could end up going out of business. So you have to manage your cash flow, your liquidity. The current ratio um, is a short term liquidity ratio to calculate the ability of an organization to meet its short term debts within the next 12 months. It calculates the value of an organization's liquid assets relative to its short term liabilities. So, liquid assets are comprised of cash, stock, and people who owe you money. These three, one, two, three. And liabilities, the current liabilities, people who you owe money to, banks, trade creditors, suppliers, basically, short term loans. So, you've got people, so money that you have, all the money that you should have in the next 12 months, over all the money you need to people who you owe in the next 12 months. This number obviously should be lower than the one above. Otherwise, it's not looking good. So current ratio, we'll put into example. Follow the example. Take your time. Not about just taking notes. Take your time to follow the example. If a firm's current assets are valued at 25 million and its current liabilities are at 15 million, it's good because it's lower. So it'll be 25 divided by 15, which gives you a ratio, not a percentage here, of 1.67. This figure means that for every £1 or $1, still using the UK money, of current liabilities that the firm owes to its creditors, it has 1.67 in highly liquid current assets, which is very good. In general, the minimum figure for current ratio for any organization should be at least 1 to 1. Because obviously, if you've got less than one, then someone's not going to get paid, and that's going to be the debtors, the people, or shall I say, the people that you owe money to. Keep the terminology debtors for people who owe you money for now. Um, so, to improve the current ratio, what do you need to do? It can take a combination of any following actions. You can see these are quite repetitive. Attract more customers, perhaps by changing the pricing strategy or improving its promotional strategies. Encourage customers to pay by cash, definitely will help you. You could maybe, I remember a company in the UK, it was a Japanese restaurant, and I remember they had it was a very good deal. Whatever you paid for in cash, you'd get I think it was 10% off, and 10% when you're keep on buying, it wasn't cheap. Japanese food, it does add up. I think it was 10 or 15% just by paying by cash. So it was a good encouragement. They needed cash flow because they're a new business. New businesses normally do need cash flow. So make different promotional strategies for cash flow. Use any available cash to pay off short-term debts, thereby reducing interest. Negotiate with suppliers for longer terms uh, or extended periods to pay them back instead of, for example, 60 days or 30 days to go to 60 days or 40 days, for example. So there you have more time to have cash and use it for different purposes instead. Acid test ratio. The acid test ratio, as you can see at the bottom, is current assets minus stocks. It's a little bit more, as you can see, it's a bit more strict than the previous ratio because the previous included stocks, and this is saying no, take stocks out because it's not coming. It's not really. You can't guarantee that anything's going to be sold in the future. So it's current assets here, just made up of only, if you remember, your cash that you actually have and debtors, people who owe you money, people who owe you money, minus the stocks, and then that is over current liabilities. It's called acid test ratio or quick ratio. This will then give a much different figure, and it would obviously the bank or whoever is lending you money will feel more comfortable looking at this figure when they're deciding how well you can pay them back rather than the the current ratio. And we'll go through an example. If a business has current assets of 18 million and liabilities of 12 and stock equals 2 million, you have to minus that 2 million from 18. So it'll be 16 million over 12, leaving you with a 1.33, sometimes expressed as 1.33 to 1. So that's money you have to the debt that you owe, or the money that you owe. This means that the business has $1.33 worth of liquid assets without having to sell any of its inventory for every $1 of current liabilities that that organization occurs. Inventory, just remember that means stock. And liabilities, as we you can understand, is the debts that the company has. It is usual to expect a bare minimum of firms to have an acid test ratio of no less than 1 to 1. Otherwise, it would mean that a business would have serious liquidity problem. For example, an acid test ratio of 0.8 to 1 would mean that for the current assets of zero point 0.8, it would have $1 of current liabilities owed. So it will be basically in the red, seriously. So it needs to be, again, at least 1 to 1. To improve it, again, same methods as current ratios. So just remember those methods from the current ratio to improve the cash flows, inflows, and reduce the outflows.